Hello, it's Richard Pears from FinextraTV, and today I am delighted to be joined by our good friend David Harris. David, as everyone will know, is the head of sustainable finance, strategic initiatives and partnerships at London Stock Exchange. Hello, David.
Hi, Richard. Great to be with you again.
Yeah, good to see you back on our screen. It's been a while since we've spoken. You've always been a great supporter of Finextra and sustainablefinance.live, which we appreciate. But today, we really wanted to get, 3 years in. Let's talk about a few of the things that we've been discussing and see where we are and where we're going to. So first of all, I wanted to ask you, we've spoken about data as obviously being the sort of bedrock of what we're trying to do in sustainable finance, ESG and so forth. Kind of what's your kind of scorecard? Where are we up to and what do we need to do next?
Thanks, Richard. I think this is, in some ways it's very, can be a bit boring talking about the data. But this is the foundations. This is actually, to actually make effective allocation of capital, to be able to get good engagement between the finance sector and corporates. It all starts with getting the data right. And there's been a lot actually that's happened over the last 3 years. So a lot of things which many of us have been calling for have been happening. ISSB has been moving. We've obviously got the climate exposure draft from them. We've got obviously the SEC in the US moving on climate reporting as well. So we are starting to see kind of mandatory climate reporting coming in, obviously, as well as EU and UK and other markets too. So which is really important because that has been very problematic. There has also been obviously a lot of kind of tech developments too. There's a lot more of kind of trying to use satellite data to be able to get real on the ground emissions data to be able to kind of cross-verify with what companies are reporting. It's still quite early days. So in terms of quite small portfolios, if you're a VC fund and you've got a small number of companies, then you can drill into that. But at the but for large diversified portfolios, it's still a huge reliance on reported data, and it's still very problematic actually. And that's why we need the mandatory reporting, because if you look at that data, if you look at say global large and mid-cap companies, it's around 60%, the largest say 4,000 companies that provide that data, 40% don't. If we look at say the Russell 1000, it's broadly similar to their kind of global peers in terms of getting that roughly to around 50%. But if we go to the Russell 2000, so the next 2,000 largest companies, it drops to just 10%. If we go to China A shares, it's 10% as well. So we've just got big gaps in the data, which means that many of us are then having to provide estimated data, and that's still a bedrock for so much of what happens. Yes, the forward-looking data and the targets, the emissions trajectories are so important, but the bedrock, the starting point is often what are the emissions now, and it's very based on these estimation models. The estimation models are highly variable. So we produced a research report a couple of years ago now. I think it was after we last spoke, but it showed that the variation between the different models, between input-output models, regression models, sector median, the differences between them, the average differences between them was 60%. What we found was if you can compare estimated with actual reported data when companies do start to report, you can then compare what was the estimates against what were the actual numbers. You find that half of the estimates are out by about 100%. A quarter of the estimates are out by 200% plus. So we've got to solve a lot of this, which is why we hope others will also kind of back a call for mandatory climate reporting. Every government in the world needs to now take what the ISSB is coming up with. We'll get the final set of kind of climate exposure reporting standard from them later this year. Every government needs to mandate that because we need that base data to work from.
And we've got, obviously the climate emergency carries on, the glaciers are still melting and all the various doom scenarios we won't go through. We've got difficulties with politics, obviously, in agreeing in pretty much anything. should you people be sitting here sort of feeling a bit sort of, oh, well, you've been talking about this for a long time, Richard and David, and yeah, you're talking about progress at the headlines, for acronyms that I'm not sure I fully understand, but what is going on in coordination across all these different groups that we hear about, and we're talking about the data utility, the net zero data utility, for example. What's happening that really people can go, okay, I see that progress is happening against what I really care about, which is the material world around the corner from me, which I see deteriorating.
So we need more collaboration between different financial actors and companies around being able to actually support transition. So what is happening is, and there has been a big development since we last spoke, which is that actually there's a much more organisation across the whole of the financial sector in trying to drive coordinated action. So that coordination is happening particularly through initiatives GFAN, so the Glasgow Financial Alliance for Net Zero, which came out of COP26 in Glasgow. But what we're seeing is different parts of the financial sector looking at how they can work together to help try and both drive capital at the solutions and being able to link capital with companies which have got effective transition plans. What we're also seeing, I suppose, linked to your point also around, you mentioned the net zero public data utility, is a collaboration between a lot of the sustainability data and analytics players coming together to support this development. So it's underpinned by the Climate Data Steering Committee, which has got all of the different big data players on it. And what we're hoping to do through that is be able to help create the development of a net zero public data utility, which would have completely open data on carbon emissions, carbon targets for companies globally. The plan is that it would ultimately go under the UNFCCC, the UN Framework Convention on Climate Change, who would run it. And part of the idea of it is to try and get a single source of the truth. So I talked about the challenges in the estimation. If we can get a single source of that provides a great basis actually for that collaborative action. So that's underway. There's currently an RFP to select a technology player to build out the platform.
David, why would those companies that have invested a lot of money and have got shareholders to be data companies, why would they make that a public good? Where will they make their money? They're not all altruistic, so forgive me for being a bit jaded there. What's the angle?
I think so. The challenge here is, as I said, that when you've got when the base climate data is so different depending on which provider you go to because of the differences in the estimations, and everyone's doing their best to try and fill these data gaps, it means, and also I suppose I should also say that companies are putting out different data in different places, and so depending on where you've gone to go to get the data, you can get different sources. So if we can have a single, as I said, single source of the truth, which means that we get that consistency, I think it improves the quality of the whole market. There's all sorts of insights which are needed, all sorts of different climate analytics about how you take that raw information on emissions and on targets and make sense of it. So there's a lot of value that different data analytics providers can play in terms of being able to provide that. But we do need to kind of try and get that common starting point, get effective foundations for action, which is what the net zero public data utility aims to do. I would say it doesn't ideally, if we can get mandatory reporting, every government mandating climate reporting, in some ways the need for this isn't there. But we don't have that today, and it is going to take a number of years before that's all sorted out, and we haven't got the time for that. So we need to progress rapid action now, and this can provide a basis for that.
So getting the data utility is actually sort of almost table stakes, although absolutely essential, because as you say, then it's a question of the models, the analytics, the scenarios, the narratives, which are then parlayed into each part of the financial sector, whether, as you say, you're a sort of small impact investor or whether you're a passive index. You can do with it what you will, and that's where people will be able to make use of that utility. Have I understood you
That's
correctly?
right, exactly.
Yeah.
And you want a diversity of ideas and views about how to make sense of that. But what isn't great is if everybody's got a different view about what the basic data is.
Yes.
And we've got to get past that. And hopefully the net zero public data utility will give an important contribution to that as a second phase thing after hopefully the mandatory reporting.
Absolutely. And you spoke about transition and so forth, and we actually had that conversation a couple of years ago about the transition pathway initiative and the work you were doing there. And interestingly, I just noted on one of your LinkedIn profiles about the FTSE for Good, and obviously there you'd announced that organisations would be leaving that if they didn't actually hit the standards. And I was talking to a data provider today who said they'd been engaged by a company who was needing to, if you like, respond to the fact they'd been removed from the index. I'm just a little anecdote, but what have you seen as the result of you putting that process in place?
Yeah, so the rubber hits the road when you get that kind of engagement with companies. So a lot of investors in the finance sector are moving capital. They're trying to hit their net zero commitments and their targets. The problem is if companies aren't aware that that's happening, that it doesn't actually change the world. It doesn't have an impact on real world emissions. It might reduce the emissions in a portfolio. And so what we did, and I'd advocate for others to do the same, is to think about how, when you're making an assessment of a company's climate strategy, getting some level of alignment around how we look at what's good enough is required. And that's effectively what the Transition Pathway Initiative brings, and also what it feeds into with Climate Action 100+. And it was an amazing achievement that investors globally came together and got joined up around how they're going to engage companies on their climate transition plans. And what we did with FTSE for Good was we took the Transition Pathway Initiative methodology for assessing what they call management quality. It looks at things like whether they have set short, medium, and long-term targets, whether they are whether they're building carbon pricing into their accounting systems, whether they are linking this kind of stuff to executive pay, etc., etc. And so we had our own climate methodology, which was similar but different. We removed that and we replaced it with a TPI methodology to make sure that what we were pushing for, what was being built and designed into the index, was then aligned with the way that investors were already engaging companies. And that way there were 200 companies who we notified and said, based on this change in methodology, and with the higher threshold that's been set around climate, there was 200 companies which no longer met those criteria. And then and the great news was that approximately 130 over the period of time before we implemented it into the index improved and therefore stayed in the index. There was also obviously a chunk of them which didn't and then came out of the index. But that I think is quite helpful, because then it means that the passive investors who are invested in it, that index also becomes a way that reinforces the type of engagement that they're already doing through TPI. I should also say that there are kind of also climate indexes where TPI will be used as a measure to overweight and underweight stocks as well. So rather than a hard in or out, as the company improves, its weight goes up or its weight comes down. But we need to get some alignment and across the financial sector in how we engage companies. And although that has been happening very effectively, I think now amongst the investor community, what GFANZ offers is an opportunity, and I mentioned GFANZ earlier on, this is the Glasgow Financial Alliance for Net Zero, but with the banks and the insurers and all parts of the financial system there, exchanges and different kinds of financial service providers too, on how we help connect up that engagement between companies and the financial sector. So a lot of the investors came together with CA100 Plus. What we now need to see is banks, insurers, and others to get aligned and joined up, so that how we assess companies' transition plans is broadly aligned. So what we're saying, what is good enough. What's not helpful is if we're all assessing this in completely different ways. And it confuses companies. It makes it very hard for them to engage with providers of capital. And it also makes the engagement more effective if those groups are have a level of alignment in how they think about and how they assess this.
So simplistically, as a corporate or whatever that's trying to do the right thing by climate change, maybe they can get insured, maybe they can't. Maybe they can get some loans from their commercial bank.
Well,
maybe they can get some investment. But if all the rules,
it might be rather than trying to do the right thing, maybe looking at really serious shifts and changes in their business model. Wants to understand that the providers of capital are with them on this journey, get it. But if they're getting completely different messages from different parts of the financial system, it makes those really big decisions very difficult.
And the government as well. I mean, I hear a lot of people in the agricultural area, where they're sort of being driven by their sort of inheritance tax and things like that. Still, there are more dominant factors such as tax and capital allocation coming from government, which drive their behaviour more than some of the things we're talking about. Do you see the governments around the world understanding the role of their incentives and penalties, if you will, in this game?
Yeah, I mean, making sure the kind of the fundamentals are right, so that you can't push capital uphill. There's got to be the investment case, and so that kind of policy engagement piece is really important, actually, to make sure that both companies as well as the investments and finance sector are very clear about what is the policy environment that we need that makes all of this possible. Because you can have a certain level of decarbonisation which is economically achievable and feasible, and there will also be a certain level of decarbonisation which requires other shifts. There might be shifts in the marketplace, or there might be shifts in terms of regulation and policy. So you're absolutely right. That's got to be a really core part of it.
Let's conclude with some good news. I know you were telling me the statistics about the green economy. Let's just actually get some clear-eyed data on this, because of course we're seeing what's happening in the US with the IRA program and what's happening with the EU, etc. What's your sense of the green economy and actually the progress we are making?
Yeah, so I think there can be this perception that there's been big growth in high carbon, particularly fossil fuel sectors, and there's been a kind of a big major reversal in terms of the growth of the green industries, and that actually, although from a short-term perspective that's true over the last kind of year and a half or so, but over longer periods it's really not. So 20 years ago, it was when we first developed our kind of green classification system, now known as the Green Revenue Classification System, and also created a range of indexes at that time, including the Environmental Opportunities All Share. Actually, I should say this was 15 years ago we created it, sorry, and then there was we created a 5-year history as well at the time. So we've got 20-year kind of record now of data. To that, I should say that Environmental Opportunities All Share is basically all large and mid-cap companies which have more than 20% of their revenues from green products and services, i.e. providing the solution products and services, whether that's renewable energy, energy efficiency, kind of water pollution cleanup, advanced batteries, etc., etc. What you find, if you look over that 20-year period, the performance of green industries is around 900%. If you look at the performance of the global all cap, that is around 600%. So significantly below. And if you look at oil and gas, it's about 500%. So oil and gas has actually still underperformed global equities over that period, and green economy has substantially outperformed both. So the long-term trend is still very much there, even though obviously since the conflict in Ukraine, there's obviously been some reversal over the last 12 months.
And what's your, just to end with, your sort of sense of what's going to happen, that we can, if we could talk about this in a year's time, what do you hope is going to happen? And also, you've done a tie-up recently with Microsoft, which has been documented. We talk to the tech community here as well. What do you think is the role of technology in everything we've just been talking about, not specifically at London Stock Exchange? So a couple of things to end with that gives us a sense of what we can expect in 2023.
Okay, well, maybe I'll give you two things. So one thing, building what I was saying before, is we are seeing, I think, more action across the whole of the financial industry. And I think things like we were involved in there's a GFANZ workstream on transition in the real economy, which was precisely about how to make sure we develop that kind of joined up message to companies. And then we had players we had a work stream with banks, with investors, with insurers that we co-chaired with AXA and NatWest, and that developed guidance across from the whole of the financial sector, made it very clear that the whole of the financial sector is moving its capital and saying to companies, get with it. But I think that can then now start to be taken to these different financial sector alliances to then as the next stage of that. So I think we'll see increasing collaboration across the financial sector. I think also what we're seeing, as I mentioned, was about this technology enhancement. So the reported data is very important, but actually how do we check and control that? So what are the alternative data types which allows you to actually check the accuracy of the information that is being reported? And we're seeing very rapid changes in terms of the types of data that comes from satellites, looking at methane plumes, looking at other greenhouse gas emissions, and being able to link those to asset level data. And so to be able to link that back, to be able to get two sides, not just what the company reports, but alternative sources to be able to verify and check that data, is going to be, I think, a bit of a game changer here alongside the regulation.
Yeah, I absolutely agree with that. Well, look, we thank you for your leadership in this area and for always updating us on what's happening. But for now, David Harris, thank you very much indeed.
Thanks, Richard. Great to be with you.